All right. Good morning, everybody. New week. This is the start of earnings week. It'll kick off Friday with the banks. There was some news on Boeing, but it looks more like it's news on Spirit Airlines than it is on Boeing. It's Spirit, which is a provider of the door piece that blew off. And so far, it was just on this one aircraft. I wouldn't be surprised at all. You know, they had 3 warnings before it blew off on 3 other flights. And that kind of gave a heads up that there was something wrong there. I wouldn't be surprised if the grounded airlines get back in the air and that Boeing stock not necessarily gets back to where it was, but gets a hard pop to the upside. So I would be cautious of anybody thinking they want to short Boeing from the hole. I don't think that's going to play out the way you want it to. It's a mixed bag. Hong Kong's down the most, more than 2%. I would expect some sort of shadow stimulus in that by the end of January. Of course, with the China ADRs, Hong Kong being down, that'd be BABA, Baidu, JD, PDD, KWeb. It is CPI week, but today we really don't have much outside of consumer credit. So, it's a week to kind of just watch the clock, be kind of cautious of longer term trades. The Fed came out over the last week or two with a mixed message, higher for longer. Maybe they won't cut right away after all. Remember, they had started to hint, to intonate that they might cut just for GP, just because. And now I think they're starting to unwind that talk a little bit and maybe hold back on cuts until it's warranted, till there's actually a reason to cut. We got additional auctions today, and we're going to get news out of Japan tonight. It's Tokyo CPI. It's just going to be a rough start. All right, volume is sitting in the normal range. The overnight cumulative volume is sitting at 92. That's well within normal tolerances. We know there's no reason for them to be hedging this morning. There's no reason for them to be sitting out, and we're not seeing any activity like that. So it's just kind of a check or a validation. We don't have, really low overnight volume, and we don't have extremely high overnight volume. We don't have a market maker move. So they're not sitting out, they're not hedging. So we're right at the daily pivot point. We opened above it, which is supposed to be a bullish bias, but we didn't keep it. Now we're tangled up in it after crossing down below it. This is just the start of a bias, right? It's just like looking out the window in the morning to see if there's rain or not. Opening above or below this might give us that first generic impression of bullish or bias, but it's not a trade signal. And of course, now that we've cut through it, it doesn't have any weight, right? It has no bias to provide. other than the fact that now that we're underneath it, it will be resistance. And you can see how it is resisting price. The thing about resistance is persistence. And think about what's causing price to not be able to get through there. So every time we come up into this zone, there's large selling happening, brings it back down again. Well, at some point, those sellers are going to not sell at that location, or they just won't have anything left to sell. And as long as the buyers keep trying to pick it up, we will cut through that zone and begin moving up to the next zone, which would be this 20-day moving average, 47.44. We're considerably below the weekly pivot point, but not overstretched at this point. We're not oversold. We're not due a bounce just because we haven't moved too far too fast. So I wouldn't start thinking about any sort of linear regression, mean reversion, dot plot statistics, anything like that. We're not due for a move like that. This is a weekly chart. And this is just a minor pullback after this really big run. So when we put it in that context, we really are doing nothing more than digesting this move, which is healthy, right? That's kind of what you want to see price do. Not big parabolic moves. You know, we don't want big runaway markets. And we're well beyond the 0.786 level that a pullback should meet anyways. So until we cut below 46.44, this is nothing more than a pullback, and I wouldn't treat it as anything other than that. We did very nearly hit the lower end of the ADR. It's the average daily range right now is 0.91. So we almost hit the lower end of it. And if we almost hit it or even hit it this early in the trading day, it opens up the likelihood that we could go to the other side and hit the upper edge, 47.57. Now there's a lot of data out that shows no matter how bullish we open in the morning, no matter how convinced it looks like we're going down or we're going up, in the first 30 minutes, the market can change direction. It's a 50-50 chance that we will change direction within the first 30 minutes of the day, no matter how convinced you are that we're going one direction or another. There's some crazy numbers, 50-50, that's a coin toss. So just keep in mind that number, right? No matter how bullish it looks, we can get bearish or vice versa. And knowing that we've already tagged the lower edge, that would open up the upper edge as a target. 10-day, 30-minute volume profile, we set the low. 4,700 basically. It's just a nice solid round number to use. And we're going to expect that to hold. If it doesn't, one of the things that we can do is measure this entire zone and plot 50% of it to the downside and then 100% of it to the downside. We are outside the 70%. I know with all these lines, it can be a little confusing, but 70% of the volume is up here in this box that I just drew. The point of control is up at the very top of that box. We're not going to lose that volume anytime soon. We've got an entire week before we can get to this volume up here and take it off. So the only way we can move this point of control right now is if we were to build a bunch of volume down below this price shelf at 47.57. We would have to stay down here and hold this zone long enough to build volume at this level and bring this point of control down. It's certainly possible. maybe even likely with CPI on the table, we could start to see more and more lack of participation as we get closer to CPI. They start sitting on their hands waiting. CTAs, vol control funds, this non-discretionary groups, they don't have a choice. They're going to trade it when their rules say to trade it. But for the rest, let the next 2 days kind of play out and see where this volume goes. But we got a lot of resistance overhead for any move to the upside. There's 2, possibly 3 if we want to combine this one here as its own rather than putting it in with the point of control. There's 3 different zones of high volume activity we'd have to get through for any sort of run back up. Now, I'm not saying that we can't do that, just that it's difficult to believe that we're going to see a coordinated effort in just price alone through price patterns, momentum, trend, that sort of thing. The only thing that's going to get us through levels like that is going to be some sort of data or catalyst, some event that will drive us up through those levels. And there's nothing on the docket that can do that until at least CPI or news, right? Some random news can always hit, but can't count on that. We are inside day behind a very wide day. Inside days normally are going to be choppy, nasty, violent, lots of reversals. They're typically difficult to trade. But if your inside day is in a really wide day like we had on Friday, then there's plenty of room. So, while the mantra is do the easy stuff, not the hard stuff, and that we want to avoid trading when we're inside of the previous day's range, it's a really big range. You should have enough room in here to see some reasonably decent trading if the opportunity presents itself. I bring this up because, I try to promote that not every single day has to be a trading day. And if you're already struggling to trade, avoiding the crappy days are really going to help, right? You just avoid that entire struggle by trading on the better days. And one of the arguments that people usually give me when I tell them that is they say, well, how was I supposed to know it was going to be a bad day until we get into the trading day? That makes sense. Except that we do kind of know, right? If we're in this zone, if we're inside of yesterday's price, it's probably going to be a pretty rough day. And if we're inside of our own Globex, once we get into the regular trading hours, then these regular trading hours are probably going to be a pretty rough day. So get out of one zone and then get out of the other zone. But when the inside day is really big, like it was on Friday, that does leave enough room for some potential price action that isn't totally trash. Your own rules will kind of guide you there, but it offers that opportunity, right? Otherwise, there's just days where I don't even bother trying to trade it. If it's trash, a narrow day inside of another narrow day, I won't bother. I'll just go do options or something. So I mentioned it earlier, we're not overbought, we're not oversold, we're not stretched, we haven't moved too far. We're not exactly sitting in the center of the basketball court, but we're less than 1% below the 10-day moving average. And we're on our way back up. We're working back towards that average. We can see the curve getting lower and lower. We're still 1.5% above the 10-week. And this kind of feeds into that bullish narrative that we have. Sure, this is a pullback. It's not a very comfortable one. But really, this is not bad. And we need these kind of pullbacks. Back before COVID, we would get 2, possibly 3 really good pullbacks a year, right? Around that 5 to 7% pullbacks. It was always the reset button for, a bunch of new longs and swings, opposed to the shorter term, 1.5 to 2.5% pullbacks. So right now, this is less than 3% of a pullback. It's not very much. Could expect at least a 5% before there's any sort of real concern. All right, we are maintaining under the anchor of the start of the year. We did close outside of last week's box. So that was the first close outside of the box in 2 weeks. That was week 3. If we measure last week's range and put it on this week's range, we can see that now that we're back to 5 days, we really didn't see a widening of the box from volatility. It really looks like volatility decreased. Remember, last week was a 4-day week. This is a 5-day week. So the box will be bigger just because we have an extra day. And it would be even bigger still if we had an extra day and we had greater volatility. The fact that it's barely bigger, even though we did add another day, suggests that even the extra day didn't bring a lot of volatility with it. I would argue volatility fell even more. And then we're continuing to see that reduction in volatility. If we look at the 5-day change on the various sectors and what they represent, then defensive sectors, staples, healthcare, utilities, energy, even a little bit of finance, but finance is going to be kicking off the banks this week in earnings. Those were the places that did good. Building materials, which had been on a tear anyways, still in a bit of a pullback. Industrials, the same. And then, of course, tech and consumer discretionary, really closer to that 5% mark that I was talking about. That's a good, decent pullback. All right, so with the dollar, we're still holding this range right above 100. And I mean, we're closer to the lower end of that range than we are to the upper end. Some really smart analysts have said, they really believe that the dollar's top is in, and that we won't see that again until, say, the next crisis or the next event, whatever that happens to be, right? So if that's true, that's not to say we're going to just continue to fade lower and lower and lower in the dollar. There's very likely going to be some moves to the upside, and we're down at these lows, threatening another breakdown here. I don't know how low this could get anytime soon, but this is what we're all watching it right now. One of the things we're all watching is what's going on with the dollar. And a year ago, if the dollar even ticked up, we'd be looking to short the S&P, the NASDAQ, but those days are gone. Now it's more about where the levels are. Dollar above 100, below 100, above 102.5 or not, and then above 105, call it 106 and or not. So I would expect we can chop about, but I don't think we're going to see any real influence of a dollar move higher until it gets at least above that 105. If we get above this, then I think a move higher in the dollar would be something the markets might start paying attention to. But until then, I think if we're still underneath it and we don't move too fast to the upside, because that would be the other thing, the speed at which we move. So if we don't move too fast upwards, then the line in the sand is going to be more weight than just seeing the dollar just going up in the first place. We got the 10-year at 4%, 4.05. And this is kind of the same deal as with the dollar. It's not just the idea of whether or not it's going up. It's how fast is it moving and where is it right now? 4%, 3.5%, 4.5, where are we at? So this one, I don't think it's going to be just as simple as giving it, like a 4.2%. At what point would this start to really get the market's attention and we would start to see, an impact from that? I'm going to start with 102, but really I think it would be more than that, closer to at least the half back, right? That 4 point, call it 4.4. But until we have more, I would say 4.2% is a really good level. As long as we're holding below that, I don't think that a positive 10-year is going to affect the markets that badly. But if we get above 4.2, then I think any move up in the 10-year is going to really be something the market pays attention to. This is what tends to throw newer traders off, right? They hear, oh, well, the 10-year's up, S&P, NASDAQ should be down. Or, oh, the dollar's up, S&P and NASDAQ should be down. And, a lot of times that's true, but it's not tick for tick, right? Not like, oh, well, this went up, the other's got to go down. And there's levels or areas that make it more valuable or not more important. So I would say we could see some positive 10-year and still not see, a smackdown in the indexes as long as we're still below at least that 4.2. We want to reevaluate at that point. I like the phrase swag levels. I didn't come up with it for sure. Somebody way cooler than me, but SWAG, scientific wild ass guess. A swag level, 4.2 for the 10-year. So things that are down this morning, nat gas, China ADRs, gold miners, energy. Not really all that exciting on the downside. Things that are up, Bitcoin. And that's the only thing that reaches our line in the sand is Bitcoin. Semiconductors are getting close, but they're not there yet. The FANGs are positive this morning, but also they're not there yet. We need more out of them than that. So we're mildly positive this morning. We just don't have enough push yet to get us into the one side or the other. The indexes are at least back above VWAP. It's a good start. We're not seeing that same kind of attention brought to the bonds, though. I mean, they're up off of that low, but they are in the lower portion of this Globex range. So a little bit of risk parity. These are the SPX levels for the day. This is the SPY. There's the SPX if you wanted to catch a screenshot. They don't have these for the futures yet. They're working on getting that data. What they do have instead is this offset. I don't use it, but you can tell them that you want to offset it and then apply it to the ES, whether you're going to use absolute values or ratio values. And then what it would do is just use the SPX data that you gave it, and it would apply it to the ES. Same thing with the NASDAQ and the Russell. They do all three, including the micros. Eight percent of the S&P is down 0.5%. 46% of the S&P is up 0.5%. So we're certainly in a mildly bullish market this morning. Nothing is up in the S&P 1%. Hold on, this thing's acting all kinds of screwy. Pre-market change below 1%. We're getting 50% of that. This thing is off. That's why I don't like TradingView in their silly little scanner. Let's use Thinkorswim. Bitcoin, pot stocks, uranium, semiconductors, those are all up this morning. So at least we can count on that. Trend spider. Not really a lot of pot stocks up. It looks like it's more of just the ETF itself. So we're getting some Bitcoin moves. Could see some of their miners, Bitcoin miners up this morning, and maybe some of those semiconductors. Hut, Hive, Mara, Riot. Even some of the semiconductors that we see up this morning are in that crypto list. So one thing that we can do is look at things that are near their put support, their put wall, and things that are near their call wall. These are the names that are at resistance and how far away from that resistance they are today. So call resistance, assets near the call resistance level. I don't try to mess with everything that I find in this list. Usually I focus on names that really stand out to me, like AMD was on here last week, Amazon was on here. I would already be focused on those names. So seeing them on here just kind of worked. To me, trading options always comes back to liquidity. So, if it's some Joe Schmo no name company that has poor options, I don't really want anything to do with it to begin with. So that's things at their call resistance. And then here is put support. And again, same thing. Just seeing a name on the list isn't enough. Knowing that name and knowing what their options are like kind of is the difference. There's two ways to trade this approach too. At the place that has this screen, they tend to focus on breakouts. So if something is at its put support and breaks that put support, heads to the downside, that's like a short-term trade. And if put support holds and it tries to run up, then that's a bit of a swing trade. These are not 0-day levels or even front week options levels. It's all of the options levels combined to make this call wall and put wall and where those levels are located. They do have front week scans. So go back to the put side put support, 0 DTE or front week screen. Amazon, the Qs, SPY, all of these are very near to their put support, which kind of argues or brings in that argument that this is just a pullback in the markets, right? That we're not looking at, a continuous trend to the downside per se. We've just got the indexes in a reasonably decent pullback. But this certainly fits for me on, names I want to recognize. Walgreens, S&P, Amazon, the Qs, even Lulu, but Lulu had news this morning too. And TMO has some serious IV rank going on right now. Let's do the call side. GameStop is on here, but I never mess with that thing unless it's just something happening in the chart on the day and I want to trade it on the day. Otherwise, consumer discretionary, AT&T has reasonably decent options. Ketchup has been an interesting trade through the last 18 months. So we got a Busby here. Right, price was at resistance, broke resistance, now is pulled back and validating the old resistance as a new support. It's got a lot of work to do in the bigger picture, but this has been a nice rounding pattern, kind of working its way back up. So seeing Kraft Heinz at its call, supposed to be resistance, and look at the number, it fell back down through it and into it. It's not rising up to hit it, right? It's the 38 strike, and 37.94 was the spot price when this scan was run. But we can see it was coming back down into that level. So 38 here, it gapped down through it. Now it's trying to come back up past it again. If you're looking for a trade in this, it needs to hold this 50% mark. So far, so good. It's looking, reasonably decent, but it has to get through this call wall at 38. And again, that's kind of how that's one of the two ways they suggest trading this scan, right? Find things that are at their call resistance, their call wall, and then trade the breakover of that. Or if it rejects and falls from here, then you've got your short. heard Apple got another downgrade, and so far it's throwing it off. So upgrades and downgrades aren't reason to go out and take a trade. But what I like to do is when I see a company get an upgrade or a downgrade, and then they do the opposite of what that upgrade or downgrade was, it gets my attention. So if a company gets a hit piece sent on them, right? Somebody comes out with a bear report and then they keep going up, I pay attention to that. So Apple got another downgrade and it's up off of the lows this morning. I mean, sure, it's not, in a sprint to the upside, but it's not down. I like this. There's always, the thing about not betting against Apple. You can take short-term trades and short swing trades in this from time to time, but it's kind of been a thing forever that you just don't bet against Apple in the long run, because that trade tends to not work out. At some point it will, right? Someday, eventually, there will come a time that Apple finally gives up the reins. I don't think it's now. So kind of keeping an eye on this as a recovery trade at the very least. You got a good 20-point run just to get back up close to that 200 level. And they've got a lot to digest considering, the moves that they've made. In such a short period of time. It's nearly an 80-point run that it has to, come to terms with. Plus, with the supply chain changes, they're really pulling out of China hard and trying to get over into India. And China, of course, is banning Apple phones in businesses and just giving them grief every chance they can get. And then add the watch issues. A little bit of negativity. Another one of the fangs, Microsoft, up this morning off of the lows, still underneath the half back. So this is one of the things that I talk about on a Monday about being gapped down or gapped up. I'm more bullish when we're gapped down on a Monday than I am when we're gapped up on a Monday. I don't like being gapped up on a Monday. So it doesn't matter, right? Doesn't matter if I like it or not, but that halfway point is something I'm really watching, not just in Microsoft, but across the board in a lot of these names that are gapped up this morning. Because if we're gapping up for a move lower, then that's a perfect place to take a rejection before starting that move lower. Amazon also still underneath the halfback. Now that was the wrong day. Hold on. That was Thursday. Tesla, same thing, up off of the lows, got the gap closed. Still underneath that 50% mark. So it's the same message in the fangs repeated over and over again. We didn't check all of them, but we're starting to see the same thing. We had a decent pullback. We're building a base. That kind of needs to hold. And, maybe not necessarily for Tesla. It's a cult name. But that's going to be the expectation. So a little concern on the gap up. Watch that 50% mark. And a break below yesterday's low should be a trigger for at least 50% of yesterday's candle. All right. So if you're looking for a trade, getting short across that 50 mark would be the cheapest, lowest risk trade you can get. Otherwise, wait for the breakdown. And I wouldn't get aggressive. I don't think it's going to be a big breakdown from here. But getting 50% of yesterday isn't out of line. I think that's absolutely on the table. Not just in Google, right? But in all the ones that we looked at. That's what I got, guys. Be careful, be safe, watch the clock. Remember what you have on the table this week with CPI to kind of adjust your swings accordingly. Not necessarily, no. I mean, I haven't read the whole article yet. I've seen a couple of the headlines, but I remember 2018 when he was smoking pot in interviews, and nobody cared. So hard to say, right?